Hello learners, we start with one new topic, that is financial re-engineering. Basically, financial re-engineering talks about some kind of innovative tools used in finance. Generally, these tools are not in practice by a finance manager, but in this, certain strategies are used, certain formulation of policies is done to boost the business of a banking organization or financial institutions. That means today we are focusing on how the financial management is of concern for a bank or a financial institution or for a financial intermediaries. So let us begin with that. So the first point which I have covered in this one, the mortgage. You might have heard about mortgage loan. When we say mortgage loan, taking a loan against the hypothecation of a property, taking a loan against the lien of a property, taking the loan against the securitization of a property or against the security of a property. So that is called as a mortgage loan. In general, you hear house mortgage, vehicle mortgage and something like that. So suppose you are interested to buy your own house, because everyone has a dream to buy his own house. But whenever you go to buy the house, you are always finding that house is more costlier than the money which you are having. So one idea might be there, let us postpone the purchase of the house, wait for the time by which we can accumulate the desired money and then buy it. But remember, next time, let us say after 1 year, 2 year or 3 year, you have built up certain more savings and again you want to go for purchase of the house. You find that again your savings or your funds are not sufficient to get you the house, because houses have become costlier. That means every time if you think that you will buy your house with your own money without taking loan from anyone, you find it is difficult to buy it. Then what is the solution? Solution is simple. Go for the mortgage loan. So particularly I want to discuss with you the mortgage loan. A mortgage loan is the one in which bank or the financial institution or financial intermediary is granting a loan to the borrower against the lien of a property, against the security of a property. So what practical mechanism is there? Let us say you as a home buyer have identified a house, its value is 2 crore rupees and you are having only 1 crore 20 lakh rupees. So you are running short of 80 lakh rupees. You can approach to a bank or a financial institution to get a loan. Now what that bank or financial institution will do? They will make the valuation of the property which you intend to buy. They will check the title of that property. Is that title free from encumbrance? That means there is no existing loan on that particular property. There is no problem of the title. Title is clear. That means the title of the property can be transferred in your name without any glitch. In that case, if bank is satisfied, it might give you 80 lakh rupees loan, depending upon your repayment capacity, your past track record, your CIBIL score and all that. So in that way, bank will give you 80 lakh rupees, you have your own 1 crore 20 lakh rupees and you can buy your dream house with 2 crore rupees. So 80 lakh is given by bank to you as a mortgage loan. Now what is the security for the bank? So bank will ask you that whatever the papers of the house are there, because you will get that house registered in your name. So one thing is clear, if you take a housing loan, house will be registered in the name of the buyer who is taking the loan and funding the money. Now papers will be held with the bank till the time you repay the loan. So bank will ask you to pay the 80 lakh rupees and interest on that. Bank might give you the time period 10 years, 20 years, 50 years and loan has to be repaid in equal monthly installment generally EMI. And I hope you remember when we were discussing time value of money, we had learnt about calculation of EMI, equal monthly installment, if you take a loan. So by using that mechanism, bank will decide the EMI. Every month you keep on paying the EMI till the decided duration. The moment your loan is repaid with interest and all the charges completely, you will get back the papers of your house. So that is the way mortgage loan will work. Mortgage loan will work. It is also called as lien against the property, hypothecation of the property. So one kind of mortgage loan is house mortgage. Another kind of mortgage loan may be vehicle mortgage. The way I have explained you that you can buy the house by taking a loan, that is mortgage loan. You can mortgage your vehicle also. So if you are intending to buy a new vehicle or old vehicle, you can get it financed from the bank or financial institution or non-banking finance company. They will finance you the money, some part of the money which is called as down payment. So what is down payment? Down payment is the one which is paid at the outset by the buyer of the vehicle or buyer of the house, and remaining money is paid by the finance company. That is called as the system of buying the house on loan or through mortgage system. It may be house, it may be vehicle, it may be any other white goods. Another thing, loan may be disbursed in one or multiple installments. So in majority of the cases, loan is disbursed in one installment at the zero time. You pay the down payment, bank will pay the remaining money, and the supplier or the seller will get the complete consideration. However, there are the scenario, because it is all the game of terms and conditions between borrower and the lender. Loan may be disbursed in multiple installments also, that can also be there. So let us say today a loan is granted to you, you buy the house, loan is 80 lakh rupees. Now when will you repay the installment and how much will be the installment? All depends upon the terms and conditions specified by the bank or financial institution and agreed by you. Generally, right from the first month, at the end of the first month from the date of loan, installment starts. However, there may be some moratorium that bank might say, since your house is under construction, you will not occupy the house for some time period due to renovation and construction and something like that. So for first 6 months, you don't pay the installment. So your installment starts from the end of 7th month. But remember, interest will be charged from the day one on the amount disbursed to you. When I say loan may be disbursed in one installment or multiple installment, let us say you have your own piece of land. You have taken house construction loan. Now construction never takes place in one day. It takes almost a year or more than that. And bank has granted you a loan of, let us say, 80 lakh rupees or 1 crore rupees for the construction of the house, depending upon your repayment capacities. So when bank grants a loan, it will always look for the 3 C's. It will always look for the 3 C's. So what are the 3 C's which are looked upon by the bank? The 3 C's which are looked upon by the bank are collateral, capacity, and third is, although it is called as character, but I'll say track record. So we can say character. So here character basically means past track record. Past track record. So what is the value of the house which you are going to pledge with the bank, hypothecate with the bank, keep as mortgage or lien with the bank? That will decide how much loan will be granted to you. So generally, whatever is the value of that house, bank might give you a loan ranging from 60% to 80% of the value of the house. Then capacity to repay. Now, depending upon your salary or income, bank will decide how much loan you can comfortably repay, and accordingly they will decide the loan. So let us say from collateral value it comes that yes, you are eligible to get loan worth 1.2 crore. That is 80% of the value or 60% of the value. So if we say house is worth 2 crore, 60% loan is being granted by the bank, so 1.2 crore. But your repayment capacity says that loan can be granted only of 80 lakh rupees. So bank will give you a loan of 80 lakh rupees. They will decide the repayment duration depending upon your remaining time of service, 20 years, 30 years, 15 years and something like that. So 80 lakh rupees loan will be granted. Character or past track record, bank will check out from your past behavior about credit card payments and loan taken from other institutions and something like that. And then they will decide whether to give a loan to you or not. So these are generally 3 C's a bank will see before granting a loan to you. Then comes mortgage loan can be of different types. We can have fixed rate mortgage, adjustable or flexible rate mortgage, interest only mortgage, assumable mortgage and reverse mortgage. So let us understand what are these 3 or 5 different kinds of mortgages. Prominently fixed rate mortgage. A mortgage loan in which rate of interest is fixed. Let us say bank has given you a loan for 10 years. That means loan has to be repaid in 10 years. And on the very first day, bank says that rate of interest will be 9% per annum and loan has to be repaid in equal monthly installment over 10 years. And it is fixed rate. That means over the complete 10 years duration of the loan repayment, rate of interest will remain 9%, irrespective of the rate of interest in the market. It will not change. Such kind of mortgage loan is called as fixed rate mortgage. Whereas adjustable or floating rate mortgage, it is called as floating rate mortgage also. Adjustable is floating rate. That bank says that it is floating rate loan. It simply means, let us say on the 0 day when bank is granting you the loan, rate of interest is 9%. But bank says that whenever in the future rate of interest is changed in the market or changed by the bank in future, the new rate will be applicable to you. And duration of the loan is again 10 years. So if we say after 1 year, rate of interest becomes 8.75. So bank will charge you the interest at the rate of 8.75. Subsequently, after some time rate becomes 9.5%, bank will charge you the 9.5% rate. So that kind of arrangement of mortgage is floating rate mortgage or adjustable rate mortgage. Then we have assumable mortgage. So fixed rate, adjustable rate and then interest only mortgage. First we understand interest only. Now as I told you, when you take a mortgage loan, you have to pay equal monthly installment over the period of the loan and loan gets repaid. When I say loan gets repaid, bank is getting back its principal amount, that is the loan amount and the interest on that also. But there are the scenario when bank might grant you interest only mortgage. It means if you get a loan of 80 lakh rupees today to finance your house and it is a unique loan of interest only mortgage. In that case, year on year, month on month, you will keep on paying the interest to the bank and the principal amount will be repaid only at the end of 10th year. So that kind of mortgage loan is interest only mortgage. Then assumable mortgage, which is also called as transferable mortgage. So generally in majority of the cases, mortgages are transferable, particularly house mortgages. If you take a loan today to buy the house and loan duration is let us say 20 years, you live in that house for 5 years, after 5 years you think to sell the house, then and loan is still pending, 80% of the loan is still pending or 60% of the loan is still pending. So one way is that you repay the loan of the bank, bank releases the original papers or document or title document of the house to you and then you can sell the house. So that may be a lengthy procedure. Another way may be there if it is a assumable loan or transferable mortgage loan, then simply you hunt the buyer who is willing to buy your house. He will buy your house and he will take the loan also. So suppose you sell the house to him in 3 crore rupees and your loan outstanding is 70 lakh. So what particularly that particular buyer, new buyer will give you? The new buyer will give you 2,30,000 rupees and he will repay 70 lakh rupees to the bank. Now it is up to the next buyer whether he wants to continue with the same loan or not. So he says, yes, I want to continue with the same loan. So the same loan will be passed on to the new buyer. He will pay the remaining 70 lakhs and interest on the future period. Therefore, you are selling your house in 3 crore to that new buyer. He will pay you 2,30,000 because remaining 70 he will pay to the bank. So it is like 70 lakh loan going in the favor of new buyer. So such kind of mortgage is assumable or transferable mortgage. And in majority of the cases, mortgages are transferable, particularly for the housing finance. Then the latest advancement is reverse mortgage. So far I was explaining you that you can buy the house by taking a loan from a bank. In that, papers or documents of the house are with the bank and you are living in the house. And you are paying monthly installment to the bank to repay the loan. The moment your loan is repaid fully, title document come back to you. Title is still in your name when the loan was there. But what is reverse mortgage? A reverse mortgage is the one in which the house owner pledges the documents of the house with the bank and bank promises that yes, every month bank will give you certain installment. And let us say reverse mortgage is for 30 years. So every month bank will now pay you. Let us say 50,000 rupees per month for 30 years. And at the end of the 30 years, what you will do? You will pay back the money to the bank. Whatever you have taken in the form of installments over 30 years, 50,000 rupees per month, and the interest on that. Now, it is just opposite of the mortgage. Now, who is eligible for the reverse mortgage and what is the purpose of reverse mortgage? Suppose a person is there who builds the house, lives in that one, he was working and he has no pension. And we generally say house property is like your second source of income. Either you can let it out or reverse mortgage helps you in surviving after the retirement. So in case of reverse mortgage, what are the eligibility criteria? The person must be of age 60 years. So this is an example from one bank's policy. Bank to bank it might be different. And number two, he must have only one house in which he will live it. No other purpose of that house is there. He will keep the documents of the house with the bank. Bank will keep on paying every month depending upon the calculations and working certain amount so that you can survive after the retirement. You get monthly income like something. At the end of the loan term, you have two options. Either repay the whole money which you have taken from the bank with interest, or bank will sell the house, recover its loan with the interest and pay the balance amount if any to you. So that is the mechanism of reverse mortgage. Unfortunately, in case of reverse mortgage, the person who has taken the reverse mortgage, he does not survive because death is inevitable. If he does not survive after 20 days, loan duration was 30 years. So bank will give an opportunity to the legal successor of the person, that is the person who initiated the reverse mortgage, that you have an opportunity, pay the bank's dues and get the papers of the house, or bank will sell the house, recover their loan with the interest and pay the remaining money to the legal successor of the person. So this is the way reverse mortgage is one of the new tool introduced by the banks under financial re-engineering so that those who don't have regular income after retirement, their house can support them in the form of a regular income. So you can live in that house and that house is giving you monthly income, monthly installment also. So few banks have come out with this kind of policy and you can do it. So dear learners, this was for the mortgages. That means a loan which is taken against the security of the property. Property may be generally movable or it may be immovable. House is immovable, but if you take a vehicle loan, it is movable property. So that is the way mortgages work. Then the next tool, because I told you, in this case we are not studying the regular finance functions. These are the tools used by the finance companies, banks, financial institutions. So one is the mortgage, which I have explained you, including reverse mortgage. Another is securitization of the asset. And this securitization of the asset was responsible, I'll say, or the prime agent or prime activating agent of subprime crisis of 2008-9, which affected across the globe, all the banking system, all the financial markets. Now, what is securitization of the debt? Securitization is a new tool in the finance industry through which assets having similar nature are grouped together and pool is created. And the one who is creating the pool, he is issuing the debentures kind of document against the pool of the securities. So let us take a simple example. State Bank of India is granting housing loan to people. Generally, every bank does that. So as on a particular date, housing loan of State Bank of India is 100 crore rupees, on which for the next 20 years, State Bank of India will get monthly installment. So one thing is sure, State Bank of India has blocked their 100 crore rupees in that, which will come back to SBI over a period of time of 20 years. It means it has affected the liquidity of the bank. Now what SBI can do? SBI can sell this housing loan portfolio to an agency called as Special Purpose Vehicle, SPV. So SPV will assume the charge of the housing loan, and these housing loan, let us say, belong to 100 people. Everyone has taken loan of 1 crore, so 100 crore rupees. I have taken a hypothetical example, everyone's loan is 1 crore. Now, practically what is the meaning of that particular assuming? So in this case, things will work like this. SBI is the bank who has granted the loan, and here is the borrower. So in general, today SBI is granting the loan to 100 borrowers of 100 crore, and over a period of time, these borrowers keep on paying the installment for next 20 years and settlement is done. Bank recovers the loan. Now what bank can do, instead of waiting for next 20 years to get the money from these borrowers, bank is selling the portfolio of their houses to an SPV, Special Purpose Vehicle, selling or assigning. So it assigns to them. Now what this SPV will do? This SPV will issue the debentures in the market. So they issue bonds. And these bonds are secured against the house loans which have been given by SBI. Now this fact may be known to borrower or not known, it hardly matters. Now practicality will be like this, that these borrowers who were earlier required to pay to SBI, now they will make the installment payment to SPV. Now SPV has issued the bonds in the market, so they have gone in the money market or capital market, any of the markets depending upon the type of instrument. Now money will come from these bonds. Now this money will be given to SBI straightway. The money coming from the issue of bonds will be given to SBI. So let us say loan was of 100 crore and bonds worth 80 crore have been issued. Rate of interest on loan is 12% and rate of interest on these bonds is 9%. So immediately on 0 day or within 1 month, SBI gets back their 80 crore rupees. Now whenever these people pay the loan installment, the loan installment will be either directly paid to SPV or it will be routed through SBI to SPV. SPV is an agency, Special Purpose Vehicle. Now let us say very first month or very first year installment is of 10 crore. Now what this SPV will do with this 10 crore? SPV will pay interest on this bond because these bonds are 9% bonds. So after paying the interest, they will deduct their service charges and remaining will be paid back to SBI. Likewise, year on year, whatever installments are paid by borrowers, they will be paid to SPV. SPV will service the loan, that means pay the interest on the loan, repay the bonds, that is the bonds issued by SPV, and remaining money will be paid to SBI. So this cycle will continue for 20 years. So in 20 years, loan will be repaid, bonds will mature, and everyone's money gets settled. But look at the fact what the benefit SBI has. SBI gave loan of 100 crore on 1st January 25, let us say. Immediately within few days it gets back 80 crore. With 80 crore it can give new loan. So that is the way we can see securitization of the asset helps in increasing the velocity of the money, improving the liquidity of the financial, improving the liquidity of the bank. But remember, these bonds are secured against the house property, against the pool of which these bonds have been issued. Now there is a catch. If by chance, due to certain reasons, these people fail to pay the installment, they don't have the money, they have gone bankrupt, then what is the recourse? SPV will sell the houses, which generally happens if the house borrower fails to repay the loan. The money lender can sell the house and recover the loan. Now who will sell the house? SPV will sell the house. They will repay the bond money, and if something is left out, they will pay it back to SBI. So that is the way securitization of debt takes place. Debt may be of housing loan, vehicle loan, or any kind of consumer loan. So one kind of new innovation is there in the market, securitization, and there is a big industry for that. Now different types of loan which can be securitized are like this. So this is the way under financial re-engineering we have learnt about mortgage, that is normal mortgage loan, reverse mortgage, and securitization of assets or securitization of debt. So dear learners, I hope you could understand the concept. These are really new concepts in practice, not in India but out of India also. So keep on learning. Thanks a lot for giving me your time.